Good afternoon. Today I'm going to be talking to you about a wealth management strategy that you can use to make your investments work for you. I am Paul Z Shelton Jr., the Chief Investment Officer of Warwick Advisors. So many of you may be asking, how can I get my investments to work for me? How can I get my money to work for me instead of me working for my money? Now, one of the greatest things that you can do, or greatest tools that you can use, is the margin ability on your account. With taxable investment accounts, your broker, such as TD Ameritrade or Charles Schwab, will allow you to leverage or take a margin loan against the investment account. What this is doing is allowing you to take out a loan, writing a personal check directly to yourself, and using your investments, whether they're stocks, bonds, mutual funds, or ETFs, that are inside of your investment account as collateral for that loan. Now, this is an awesome thing because you no longer have to go to a bank in this situation, go through the underwriting process, pay an initial fee or pay a closing cost to take out money. You're able to leverage your own assets that you've saved over time, or assets that you built up in a taxable account. Again, this cannot be done in an IRA or tax-deferred investment vehicle, only in taxable accounts. But you're able to leverage those assets, pull out money, and use that money for anything that you desire to use it for. If you're funding the start of a new business, if you're paying off debt, which I highly recommend in certain situations, or if you're need a loan for a home improvement or anything of that nature, or even speculating in the real estate market and purchasing a new home, you can use those assets for that as well. Now, I mentioned before that there is no closing cost and there is no underwriting fee or underwriting process that takes place with taking out a margin loan. It's a fairly simple process. Let's use an example. Let's say you have $50,000 in your investment portfolio and you want to leverage or margin ability on that portfolio. The best thing you would do is have the ability to write checks from that investment account. Write yourself a personal check for, let's say, $30,000. Most accounts will allow you to margin up to a certain percentage of what you have invested in the account, and there could be a variance in the percentages based on the type of investments you have in your account. But let's say you have the ability to margin all the way up to 100% of the account, but you only choose to take out $30,000 of the $50,000 within the account. So you can write yourself a personal check for the $30,000, deposit the $30,000 into your personal checking or savings account, whichever you're using it for, or you can take that $30,000 and pay off a student loan or pay off other debt to consolidate debt. The beautiful thing about the margin loan is you will have typically much lower interest rates than you would have if you were to go to a bank and take out a traditional loan. You're using your own assets, so the risk is not to the bank, the risk is for you directly. So interest rates are going to be much lower that you'll have to pay to TD Ameritrade or Charles Schwab or whatever brokerage firm that you're using to take out this margin loan. A good strategy that we like to use at our firm is to structure the margin loan so that the investment portfolio is deriving a greater income, such as income from the dividends and interest from the portfolio that is greater than the interest that you have to pay back in the margin loan. This allows your investments to pay off the interest and pay down the principal on that margin loan as the investments go throughout the course of time. So we're currently in a monetary easing environment in our economy. The Federal Reserve is reducing interest rates, which is advantageous for those that are looking to employ a strategy such as this. It makes your margin rates on those margin loans much lower. Now, there are some risks with taking out a margin loan. The biggest risk is the collateral or the stocks, the bonds or ETFs within your investment account lose value. If we get into a situation where there is a massive amount of volatility in the market and those values are dropping for those investments, then that's going to cause the collateral the value of the collateral to decrease, and there could be an issue with the marginability of the loan. Your loan to value could shoot up higher than what it initially is, or what the broker says is allowable at that given time with increased market volatility. So I always suggest that you sit down with your financial advisor, have a good heart-to-heart conversation, and discuss what your goals and what your parameters are. And if everything lines up, this could be a very, very good strategy for you. It helps you reduce the amount of money that you have to borrow and the amount of interest that you have to pay in high loans to banks, and it allows you to use your own personal assets to fund your dreams. That's what we're about at Warwick Shore Advisors. If you have any questions or any concerns, or if you'd like to talk more about this particular strategy, please leave a comment below or reach out to me directly at investments@warwickshore.com. And as always, please like, subscribe, and share this video for more content and updates about all things financial. Have a great day.